Something historic just happened in the silver market, and almost nobody is talking about it, because the truth is simple. The system didn't bend, it snapped. For the first time in decades, the global silver supply chain is showing signs of outright mechanical failure. Refiners are delaying shipments, mints are halting allocations, and major bullion distributors are quietly warning their clients that delivery dates are now uncertain. This isn't normal volatility, this is a structural break. Because at the exact moment physical demand is exploding, mine output is barely moving, and inventories are collapsing at the fastest pace in 20 years. And now we have reached a point the industry hoped would never come. Physical silver is starting to decouple from paper silver, spot price is freezing, premiums are exploding, and industrial buyers, the solar producers, the battery manufacturers, the tech giants, are suddenly realizing they're all competing for the same shrinking supply. This isn't a forecast. This is happening right now. And if you want to understand why silver could become unaffordable by 2026, you have to start with what just broke. Because in the last 90 days, global silver withdrawals from major vaults reached levels we normally see only during financial panics. But this time, there's a critical difference. The metal isn't coming back. On the wholesale side, some refineries are now quoting 8 to 20-week delays for large orders, an unheard of lag in a stable commodity. That's not a backlog. That's a system under stress. Meanwhile, industrial users are quietly preparing for rationing. Solar manufacturers already admitted in internal filings that silver consumption is rising faster than expected, and faster than supply can respond. Even the largest mines can't expand output quickly, because over 70% of silver is produced as a byproduct of other metals, meaning even if the price doubles, nothing changes. This is why the market is breaking. There's no emergency switch to pull, no lever to increase supply, no OPEC of silver to fix the deficit. The system is running on inventories, and those inventories are evaporating. And here's the part almost no one sees coming. When industrial users panic, they don't buy small. They buy everything. Tech companies, solar manufacturers, and battery producers do not wait for shortages. They buy ahead of them. And when they step in aggressively, retail buyers get pushed out of the market completely. This is exactly what happened in palladium. This is exactly what happened in rhodium. And this is exactly what appears to be starting in silver. Right now, the world is entering a three-way collision. Retail investors want physical, institutions want hedges, industries want survival. And for the first time in modern history, there simply isn't enough metal. The signals are already here. Premiums on physical silver are rising, while spot refuses to move. Vault withdrawals are outpacing inflows. Mints are reporting unpredictable production schedules. And the silver-to-gold ratio is breaking out of historical ranges at a speed not seen since the 1970s. Something is shifting, and fast. Because once physical silver consistently trades above paper silver, the illusion of price stability disappears. And the moment that illusion disappears, demand explodes again. This is the beginning of a feedback loop. And once it starts, you cannot stop it. The silver market isn't tight, it isn't strained, it isn't volatile, it's breaking. And if the trend continues for another 12, 18 months, the world will enter a phase where physical silver becomes more rare, more costly, and more strategically important than the average investor has ever imagined. This is no longer about charts, it's about survival, for industries, for supply chains, and for any system that relies on silver to function. And that will spy us why the next phase, the 2026 phase, is where things become truly dangerous. Because what comes next isn't a price spike, it's a repricing. Silver isn't just tight anymore, it's disappearing. Across major exchanges, registered silver is being withdrawn at a pace that looks less like normal market activity and more like an evacuation. Vault reports show net outflows in multiple regions simultaneously, something that almost never happens unless confidence is collapsing from the inside. But here's the part that should worry everyone. These are not retail withdrawals. These are institutional-sized movements. Tens of thousands of ounces being removed at once. No redeposits, no rotation. Just gone. And while inventories vanish, global demand keeps hitting new records. Solar manufacturers are now consuming so much silver that some analysts warn the energy sector alone may overwhelm the entire global mining industry within 2 years. Not in a decade. Not in an extreme scenario. At the current trajectory. This means even if investment demand went to zero, the world would still be in a deficit. But investment demand isn't going to zero, it's rising. Because the moment the public sees premiums climbing while spot stays frozen, they know something is wrong. And that's exactly what's happening. Premiums on basic bullion have surged, with some dealers raising prices multiple times in the same week. This is not seasonal, this is not cyclical, this is stress, deep stress. Meanwhile, paper markets are trying to hold the illusion of stability. But the gap between paper and physical is widening fast. In the last major silver crisis, the premium gap was a warning shot. Today, it's a siren. because when spot price no longer reflects actual availability, the system loses its anchor. And once the anchor breaks, markets don't correct, they reset. Industrial buyers are already responding. Some large manufacturers are locking in multi-year silver contracts, essentially front-running the shortage. Others are exploring emergency backup suppliers, even at higher costs. This tells you one thing: they expect the situation to get worse. And here's the most alarming development of all. For the first time, multiple sovereign mints are reporting disruptions at the same time. Some are pausing silver coin production. Others are limiting allocations. One mint even admitted they cannot source blanks at a predictable rate. This has never happened in a synchronized global pattern. Meanwhile, refineries are sounding their own alarm. Many are now operating at full capacity, with order books stacked months into the future. Yet they still can keep up. This is the moment when the crisis stops being theoretical. This is the moment when silver transitions from a commodity to a choke point, because the industries that rely on silver cannot function without it. This means every supply chain downstream is now exposed. Solar installations, electronics manufacturing, automotive production, defense technology, medical equipment. If silver supply falters, these industries will pay whatever price is necessary to secure the metal they need, whatever price. And when industrial buyers enter a bidding war with investors, the market stops being a market. It becomes a survival contest. The early signs are already here. Some industrial customers have reported being outbid by other industrial customers, a rare and dangerous escalation. This is the prelude to the 2026 phase. Because if nothing changes, if inventories keep falling, if demand keeps rising, if supply remains flat, the world will collide with a mathematical reality. There won't be enough silver to meet demand. Not at current prices, not at double, not at triple. This is the setup for a repricing event, the kind that doesn't happen gradually, but suddenly. It is a repricing event, a moment when the financial world is forced to admit that the price everyone sees is no longer real. And that moment arrives when availability collapses faster than the system can hide it. That's what 2026 is shaping into. The signs are already flashing in red. Major refiners now report they cannot meet bulk industrial orders on time. Solar companies are warning investors that silver acquisition is the number one operational risk. Electronics manufacturers are revising production schedules because they can't secure long-term metal supply. And most alarming of all, government agencies are quietly reviewing strategic silver requirements for the first time in decades. When governments start paying attention to silver, you know the crisis is bigger than the market admits. Because unlike other metals, silver has no large above-ground reserve ready to be released in emergencies. Gold does, oil does, copper does, silver doesn't. Once the system runs out, it runs out. Which brings us to the unavoidable turning point. The moment industries begin bidding against investors for the same final ounces. Industries cannot operate without silver. Investors can choose to wait, but industries cannot. This creates a brutal dynamic. Industries buy at any price. Investors refuse to sell. Refiners cannot supply enough. Mints cannot meet demand. Spot becomes irrelevant. This is how repricing begins. Not with a chart, not with a headline, but with a silent shift in market behavior. When the price printed on the screen no longer reflects the truth in the real world. And that shift is already here. Wholesale premiums for large bars, the last cheap part of the market, have begun diverging from spot price. This has only happened during major financial stress events, never during normal economic conditions. Meanwhile, retail premiums have exploded. Some dealers are charging the highest spread since the 2020 lockdown crisis, even though official silver price barely moved. This is the separation of reality and illusion. This is the beginning of a market resetting itself. And if you think 2026 looks far away, consider this. The world is currently consuming more silver than it mines every year. Not occasionally, not during spikes, every single year. And this deficit is accelerating. Solar alone may require over 20% of global production within 3 years. Electric vehicles demand more silver per unit than almost any other consumer technology. Semiconductors need ultra-high purity silver that cannot be substituted. Medical and military systems rely on silver as a critical component. This is the part the public never understood. Silver is not just a precious metal, it is an industrial necessity, embedded in every modern technology and impossible to replace at scale. When a commodity reaches this level of non-negotiable demand, but supply remains flat. Repricing is not optional, it is inevitable. 2026 becomes the year the system acknowledges it. The year when investors realize the paper market has been masking true scarcity. The year when industries cannot secure long-term silver contracts without paying multiples. The year when premiums explode so far above spot that the screen price becomes meaningless. The year when governments start competing with private industries for a strategic silver stock. And when these forces collide, the market has only one response: reprice upward until demand is destroyed. That is how every commodity crisis in history resolves, from oil in the 1970s to palladium in 2000 to rare earths in 2011. Silver now sits at that same inflection point. And unlike past cycles, this one is global, structural, and mathematically unavoidable, because at the end of the day, the world doesn't have enough silver for the technology it plans to build. Not at $25, not at $40, not even at $100, which is why the question for 2026 is no longer, will silver go up? It's, will you be able to buy physical silver at all? Because when a market breaks, it rarely announces it loudly. It happens quietly, in the data, in the delays, in the premiums, in the decisions industries make behind closed doors. And by the time the public realizes it, the repricing has already begun.